Are you looking then at the development stage a bit more now, as you say? So
Yes.
companies that either have a DFS or have nearly got a DFS and they're on the road to financing, to getting what they've got in the ground. So you're not looking for discovery stocks, you're looking for development stories.
Absolutely.
Right.
Absolutely.
Okay.
I think that will be the sweet spot in the market for the next couple of years.
Okay.
We have now very important underpinnings for a very long bull market, possibly 5 to 10 years.
Well, I'm here on the balcony at Resourcing Tomorrow with Angelos Damaskos from Sector Investment Managers. Angelos, we met in Zurich. I hosted one of the panels with you a few weeks ago.
Yes.
Thank you very much for speaking to me in person.
Pleasure.
How are you finding the show, first of all? You were saying just before we recorded you had 4, I think, almost back to back in the last few weeks.
Yes, well, it's conference season. November, early December is when the whole community descends to London to meet people and exchange ideas and raise capital. There's been a lot of capital raised in the last few weeks.
Really?
By all the companies.
Okay.
And I see a lot of private placings being launched. Most of them are oversubscribed.
Really?
So it's an illustration that the sector is very, very bullish and investors are much more interested now. And on to your question, I noticed that this event is probably twice as busy and as active as it was last year.
Last year, okay, right, yeah. Okay.
And also you can feel the optimism and the excitement of the companies.
I've been here before and there was not optimism. Yeah, it's definitely changed in the last couple of years. So I agree with that. When we were in Zurich, I think it was on our panel that we were talking about cash and investment funds having more cash. And I think, are you fairly heavy cash at the moment?
Yes, we have moved a little bit, quite a bit actually, into cash because of the way our fund structure operates. And admittedly, it has been a relatively easy decision to take because we've had such strong performance this year.
Yeah, okay.
And it would be imprudent, to say the least, to leave it all up to the market because we have lived through the markets. I started my investment business in 2002, so 23 years ago, and I have lived through many cycles, and I know how quickly it can change the sentiment.
So it's good discipline.
You have to be very disciplined as an investor.
Yeah.
And I think it is time to be a little bit cautious, particularly with regard to the overall markets. I'm not so concerned about the gold price. I think the gold price is supported by the macroeconomics, by the geopolitics, by what the Trump administration is doing, the lack of confidence in the US leadership, the lack of confidence in the US as a stable ally, as a policeman of the world, if you like, as a reliable trading partner now. And this is what pushed the gold price so high so quickly this year. People lost confidence in the US and realized that they need a store of value and a safe haven in their portfolios.
Yeah, okay.
So it has been mostly the generalists and financial investors who have been buying gold, whereas before, for years, it has been mainly the central banks buying gold.
Right, okay.
So now we are in this sort of new paradigm where people are looking for safe havens. They have bought into gold, but if something happens to the global markets, there could be a number of things happening to destabilize the markets, and we have a general liquidity events where there is a correction of some sort. It could potentially spill over into everything. It could spill over even into gold as people scramble for liquidity.
Yeah, well, exactly.
So it's sort of prudent to be a little bit cautious coming into the end of the year.
Okay.
And then let's see what happens next year, early next year. But generally speaking, if one is exposed, and that's how we position our investments, if one is exposed in solid cash flow producing businesses, plus those businesses that have very sustainable projects that can be financed or have already been financed and are being built to come into production, you can't really go wrong in this environment of high gold prices.
Yeah.
Even if there is volatility, you might suffer a little bit of a drawdown, but I expect gold prices to be sustainable through next year and possibly go up to $5,000 an ounce. So all of these businesses will recover, will do much better.
Well, you were on the panel with Willem, weren't you?
Yes.
Yeah, and I think I quoted him from March when he said 5,000 in 18 months' time. for gold.
Yes.
So we are on the track, on the way to that.
Yes.
I think we do understand the reasons behind the strength in gold. As you say, it's an inflation hedge. Central banks are buying. We're perhaps seeing not a confidence crisis, but some concerns about the dollar, for example, and government debts, and central banks are backing that with real hard assets. We also talked on the panel about the crypto, or and I know you're not a huge fan,
No.
but we're seeing some of the crypto elements sort of buying the hard asset as well, which is wow. You would never have thought that a few years ago. So I think we can understand the gold situation, of course China buying it as well. But in terms of the cash, then holding a bit more cash, so are you waiting to pounce? Because you said earlier that cash is being deployed, companies are getting their kind of raises away. Are you fishing at the moment? Are you waiting to pounce a bit?
Absolutely. So what we have done is that we have actively reallocated the composition of our portfolios. For the last 2-3 years, we have been shielding into the producers because the market was uncertain. There was scarce capital. The small companies were struggling to raise capital, whereas the producers were seeing an expansion in profitability and a growth in free cash flow.
Sure.
So we are positioned mostly in the producers, particularly what we then consider mid-cap companies.
Yeah.
Now they have gone up, they have become large caps, several $1 billion each, as a re-rating happened. But as this re-rating has happened now, my thought process is that a lot of the cash that these companies are generating will have to be deployed to new projects and acquisitions and growth. And the most likely candidates are going to be development stage projects.
Right, okay.
Projects that have been defined, have a definitive feasibility study, they are on the road to financing, or they are currently being financed. These are the corporate acquisitions that the very cash-rich mid-caps will now seek to buy.
So are you looking then at the development stage a bit more now, as you say? So
yes.
Companies that either have a DFS or have nearly got a DFS, and they're on the road to financing, to getting what they've got in the ground. So you're not looking for discovery stocks, you're looking for development stories.
Absolutely.
Right.
Absolutely. Okay. I think that will be the sweet spot in the market for the next couple of years.
Okay.
And I explained the reason, because I think all of that cash that is being generated will have to be deployed somehow.
Sure.
So if you think about it in simplistic terms, if I'm a producing company and I'm sitting on $1 billion of cash, I can mobilize some of that cash to buy the company, then some more to lower the cost of capital and bring the project to production very quickly, much quicker than the smaller company will have to wait. And you have to appreciate that most of the development companies take on average 2 to 3 years just to get to the construction decision.
Yes.
To pass all the studies, feasibilities, financing, debt financing, equity raisings, etc., mezzanine, perhaps royalties and stuff. It takes an awfully long time. Whereas if I'm cash rich and I can mobilize that financing quickly, I lower the cost of capital, I condense the mobilization period. Even the construction period is quicker because I have my own staff to deploy. So I can bring the cash flow much further forward and reap the benefit of the current high gold prices.
And then when it comes to the juniors then, so let's say the ones that are trying to get a discovery, is that not your bag, or would you look at that in a later stage?
We do look at certain situations where we think there is attraction, but I'm much more careful on the juniors because, first of all, exploration is a difficult game. Even if you have a discovery, it doesn't mean that the resource is economically mineable. So it takes many years and a lot of drilling to develop this economic viability. And we are all familiar with the Lassonde curve. There is hype and activity when the first discovery takes place, and then things slow down and people take stock what is there really in the ground. So there is probably a handful of situations I've seen in the last few years where there was true value discovered in the ground and merits long-term potential.
2 or 3 out of what?
Out of thousands.
Thousands.
Exactly. So you have to be really careful, and you have to be diversified as well. because okay, very few people are so lucky or successful to pick only the gems. Most of us have suffered, years of waiting for something to develop.
Absolutely. I mean, obviously it's where you make your outside returns, but you're right. I mean, picking them is hard. I've got to talk to Willem about that, because his Discovery Commodity Fund is all about that, isn't it? It's that sort of discovery.
But that again plays down to the diversification, because if you have a diversified portfolio like Willem's, and you have, say, 50 or 60 holdings, you only need 1 or 2 to be spectacular successes, and that makes your return.
Absolutely.
So.
Okay, that's really nice. I like that. I like that you're looking at the development stories. I mean, just on that theme, are you looking at any particular commodities sector in that, or the general?
Gold, silver, copper.
Okay.
Some of the metals that are more sort of esoteric or critical are very interesting.
Most of them are critical now, aren't they?
Most metals are critical, but some are more critical than others, where the US relies on, and that's where.
What would they be?
There is, things like antimony.
Antimony,
like manganese. We think is a very important element. Not the base commodity, the manganese, but more the high purity manganese that goes into the cathodes of batteries. That sort of metal, titanium, is becoming quite tungsten as well. Tungsten for the defense industry. Tungsten goes into munitions and that sort of thing.
Absolutely, okay.
So,
and I'm just thinking, I always like to give our viewers, and I know you're not keen on stock tips, but you did give a couple in the SMI, but I'm not going to talk about them. You have to be at the SMI to get that. But maybe you have said what you're looking for. It's like on the road to finance and the DFS. Are those the key things, really? I mean, perhaps within that, is there anything else? I don't know. I'm trying to think of things that people can tangibly go out and look at. It's like, okay, I found this company. Okay, they're getting a DFS out, but is there a resource number they could look at, a grade, or any kind of metrics?
The DFS will analyze the resource and the grade, because the concept of the DFS is to analyze the economic potential.
And you're looking to take a position after the DFS.
Even at the stage of DFS before, because we can be ahead of the market a little bit before the DFS is actually published. So if you know the company well, if you can analyze and expect what the DFS might delineate, and a lot of that can be visualized from the PEA and PFS.
Right.
So there is already, usually in those projects, there is already quite a lot of information in the public domain.
In the previous studies.
To be able to analyze and see what is the DFS looking like. And then, of course, permitting is a key factor. First Nations involvement, if it is in North America, particularly Canada. Any potential problems with public consultation or objection to the development of a project. These are key things to look at.
And I mean, is it as simple as, if you look at the PA, for example, if you're trying to get ahead of the DFS, yes, this project is economic, yes, no. Is it as simple as that, or are you looking for specific kind of capex concerns?
Yeah, absolutely.
Margin?
I mean, there are so many elements in a DFS that one has to analyze, and you have to look at the longevity of the project in terms of mine life. You have to also look beyond the DFS if there is the so-called district potential for exploration activity. Because the DFS will focus on a distinct area of the project that will be mined, where the mine plan is. And that's the first stage, basically, of development that needs to be financed. Beyond that, usually there is a lot more to identify in the properties, in the tenements of the company. And these are the things that would attract a larger company to make a bid. Because they are not necessarily interested just in the project that the company is looking at. They are interested in the longer term potential of the areas.
Well, that's why I guess people could perhaps consider going to your fund, because you've got people, I guess, working on this all day, every day.
We've been doing this for a long time, so we kind of have an understanding of what to look for.
In the resources sector?
Yes.
So finally on that then, very cyclical sector. I don't know if you caught Wasif Latif's return to tangibles theory and the sort of cycles we went through 1917, gold cycle, Japan, .com, tech now. He's positioning himself in the return to tangibles, right? And I got the sense from Zurich that we're in the early innings, it's just getting started. So where do you think we're in for a great time in this sector? You've probably seen a cycle or two in your lifetime.
I think so. We have now very important underpinnings for a very long bull market, possibly 5 to 10 years.
That's what I want to hear.
Yeah.
I've been doing it since 2012, so I haven't really seen a bull market.
Yeah. Well, you started at the top of the previous bull market, and you suffered.
Yeah, because 2011 wasn't it? Yeah, that's very true.
Yeah.
Yes, very true. Yeah.
Yeah.
Well, you know, I was 23, so I didn't know what I was doing, but you know, you pay for your education in this sector.
Absolutely.
No, good. Okay, well, thank you very much, Angelos, for your time, and happy Christmas.
And you, all the best. Thank you.
If you enjoyed this interview, then give us a thumbs up, a like or a retweet. Subscribe to us on YouTube or follow us on Twitter and hit that notification bell to be the first to know when we release new content. There's loads of great content on our website too, across all our programs at stockboxmedia.com. Thank you for watching.